Now, as has been the case for the last few weeks, I wanted to start this by talking about the macro. And markets have been turbulent since April 2nd. We know why. It's Tariff Liberation Day. It has caused a lot of turmoil and anxiety and uncertainty. And it, of course, is the worst macro period for markets, and at least in my 30 years that I've ever seen. It's worse than COVID. That the macro has gotten messy, but the economy does not appear to be unraveling, and therefore we don't think you should get too bearish, because we're still in a bull market. I know it's been horrific and feels terrible, and it was not clear to us if this would be a V-shaped bottom or a range trading bottom like 2011. Bitcoin's finally catching a bid. Bitcoin fell while gold rose during the February to April period when asset markets were deleveraging. And that's because institutional investors were cutting leverage, and when they're cutting leverage, they're cutting their Bitcoin longs. But in the last couple of days, the opposite's happened. Gold actually has been cooling and Bitcoin's been rising, and I think there's a convergence trade there, and that's a lot of upside for Bitcoin.
Tom Lee begins by acknowledging that, yes, turbulence is still very much in the air. The macro environment remains deeply uncertain, and if you only focused on economic signals like slowing growth, inflation fears, or debt stress, you might think we're headed straight into economic Armageddon. He references the dire warnings from groups like Bridgewater, who have discussed the emergence of a different world order, and others who believe the era of American exceptionalism is ending.
So we're still through this period of turbulence, but because of developments this week, I believe that this is all resolved in a positive direction for stocks. So let me explain. There has been this conflict because the macro remains uncertain. If you're only focused on macro, you'd be nervous for these reasons I'm listing here. But if you looked at the equity markets, these things would get you quite constructive. And so this was the battle that had been taking place for the last few weeks between the stock market internals and the macro outlook. If you're macro, you might say we're facing economic Armageddon. That's something that Bridgewater has talked about, a different world order. Some people talk about the end of American exceptionalism. Others say that the top is in for the US stock market, similar to Japan in 1989. And of course, there's many people telling you that you should only be in gold and muni bonds. And gold, of course, is doing great, up 26%. It's the best since 2010. And of course, many people think there's opportunities in muni bonds. But the story of the equity market has been different. There's been pervasive bearish sentiment. You know, the AAII percentage of bears has been over 50% for 9 weeks. And the internal low was registered. We talked about that when you look at the VIX. That a VIX going over 50 and falling below 31 has always marked an internal low. And then later in this video, I'm going to talk about the 4 signs that a bottom is in. But at the end of the day, I think the equity market got this right, and it's resolving. Things are now resolving positively for stocks. So what are these signs of a bottom? Well, there's 4 of them, but I'm not going to take it in chronological order. I'm going to start with what was triggered this week on April 24th, which is the Zweig breadth thrust. Now you're wondering, what is a breadth thrust? It's developed by Marty Zweig. It looks at a 10-day moving average of advancing versus declining issues. And the idea is when it goes from oversold, a reading below 0.4, and then back to 0.615 over 10 days, that's a bullish reversal. That has happened 11 times since 1978. And notably, 1 month, 6 months, and 12 months later, stock markets are always up. And this was triggered on April 24th, which was Thursday. On Wednesday, April 23rd, the high yield market options adjusted spread recovered 50% of the widening. What I mean by that is on January 24th, high yield spreads were 292. They exploded to 530 basis points wide on April 7th, but they touched 409, which is below the 50% retracement. That's a positive development because we are now walking back from a recession risk. If high yield spreads had gone from 500 to 1,000, a recession was guaranteed. But instead, it's reversed. Almost all the widening back to even levels before April 2nd. On April 22nd, again, happened this week, we had 2 consecutive 90% advancing days. That means that stocks within a couple of days apart had posted 2 days where the advancing gains were 90% or more. And as you can see here, this 3 times since 1979. Stocks are higher 3, 6, and 12 months later. And that happened on April 22nd. Now, I covered this last week, but the VIX closed below 31 after going above 50. So the last thing, of course, that would probably convince everybody that the bottom is in is if the stock market recovered 50% of its decline, which is 54.91 on the S&P. So that's the level to watch. The S&P peaked at 61.47 on February 18th. It fell to 48.35 on April 7th. The halfway recovery point is 54.91. And we closed on Thursday at 54.85. So we're 6 points away, 0.1%, so almost there. And of course, that really amplifies and confirms what we've been saying for the past few weeks, that we're still in a bull market. I know it's been horrific and feels terrible. And it was not clear to us if this would be a V-shaped bottom or a range trading bottom like 2011. Now, there are things that can go wrong. I covered this last week. The tariff war with China could turn into a Cold War. Are the shocks going to lead to a global recession? Not yet, but of course they could. Could the financial crisis lead to rapid deleveraging? Could inflation expectations explode? Could S&P estimates fall a lot more than 20%? Maybe. These are the things that people are going to worry about. But we also think stocks got really washed out. And as you know, I've been talking about this with Tesla, that Tesla, we think, got so washed out that they reported terrible earnings on Tuesday after the close this week, and the stock rose. And it's actually had 2 consecutive gains now, and now solidly trading above its 20-day moving average. That's constructive in my view. And it's a positive surprise. Similarly, Bitcoin's finally catching a bid. Bitcoin fell while gold rose during the February to April period when asset markets were deleveraging. And that's because institutional investors were cutting leverage, and when they're cutting leverage, they're cutting their Bitcoin longs. But in the last couple of days, the opposite's happened. Gold actually has been cooling and Bitcoin's been rising, and I think there's a convergence trade there, and that's a lot of upside for Bitcoin.
Similarly, Bitcoin is finally catching a bid after months of selling pressure. Earlier, Bitcoin fell even as gold surged, a result of broad institutional deleveraging. But now, Bitcoin's rally alongside a cooling gold market suggests the return of risk appetite, another bullish signal for broader markets. Tom also points out that MicroStrategy, closely tied to Bitcoin's performance, did not make new lows during the worst market sell-offs, another subtle bullish divergence.
And that's good news for MicroStrategy, which, as you can see here, did not make a new low on April 8th. It bottomed on March 11th at 231. So again, a lot of important, thematically important stocks have looked like they washed out. In terms of granny performance, individual stocks by week, the top 5 performers in the past week were Netflix, Palantir, MicroStrategy, Abbott Labs, and Costco. And the bottom 5 contributors were Microsoft, AMD, Amazon, Meta, and NVIDIA. In terms of themes, the number 1 performer was cybersecurity, really led by Palantir. The second is the style tilt. Again, and that's the benefit of us using style tilt because that changes every quarter, but you can see Netflix, Palantir, MicroStrategy are really driving those upside gains. And seasonality was a drag, and you can see that's really driven by Meta. And easing financial conditions really benefited, again, from Netflix's inclusion, as well as Garmin and some others. So just to reiterate, if you're wondering why do we call this granny shots, it's referring to an unconventional way of shooting a basketball free throw, popularized by Rick Barry, who made 90% of his shots. It's underhanded versus most people who shoot overhanded. We achieve a granny shot by focusing on themes that we think are structurally important over the next 10 years, like millennials, global labor suppliers, the rise of automation, cybersecurity, financial conditions easing. We also look at style tilt, seasonality, and things like PMI recovery. And not only do we focus on those themes, we find the strongest stocks associated with each theme. But then to be a granny shot, you have to appear in more than one theme. So therefore, stocks that appear most often are the strongest granny shots, as is shown here: Google, Meta, Palantir, Apple, Caterpillar, Garmin, and NVIDIA.
Despite the negative macro headlines, the stock market internals are flashing green lights. Technical indicators, sentiment washouts, breadth thrusts, and recovering spreads all point toward a durable bottom forming and the beginnings of a renewed bull move. Of course, risks remain. They always do. But Tom reminds us that markets climb a wall of worry, and based on the data, that climb might just be starting again. If you found this breakdown valuable, make sure to hit that like button, subscribe for more market insights, and comment below what you think. Are we at the start of a new bull market, or is it just another bear market rally? Please like and subscribe.